Okay. Well, 131 points higher for the Sensex. Krishna Kumar joins us now to talk about what's happening in the mid-cap space and how should one read into the emerging market currency. Krishna, good morning. Thank you for joining us. Every second question I've been asked by on Twitter, social media, my friends and old-time investors is, "Bhai, mid-cap mein kya ho raha hai? Is the party over?" And how are mid-cap fund managers defending their funds, their ideology to invest in mid-cap stocks right now when there is pain?
Sure. See, I think we are clearly in a phase of the markets wherein the sentiments are definitely impacted, because of both global events and also impact of some of these global events on Indian macros, as we were discussing earlier. Crude at close to 80 is something that one did not anticipate, and that has created a lot of pressure on the trade deficits and the current account, and also how the fiscal of the current year could deteriorate if at all. This also has created its own impact on expectations on inflation, interest rates, etc., which have also moved a little bit northwards the short term. So in the midst of these deteriorating move on the macros or perceptions that it will continue, the investors probably have pulled out from some of these mid caps which people perceived were quite expensive. So this trade of mid caps being sold down has been happening from November, December of last year, and in the last 5-6 months, you have seen that there has been a 15% plus divergence in mid caps vis-a-vis large caps, basically. So I would believe that a large part of the volatility and the downward bias has resulted in the stocks becoming a lot more reasonable in valuations, and you've also seen that there has been a strong earnings growth that's been witnessed in the last 6-8 months, and compared to broad-based Nifty BSE 100 growth of about 5-6% to 7% ex financials, you would find that several mid-cap portfolios have weighted earnings growth of 20% to 30% in the results that have come by. So there is a very strong growth that you are seeing. The differentials are there to see. So I would think that this weakness is something that one should be using to get into mid caps, basically. The other factor which also impacted the mid caps has been the SEBI rationalization of schemes, and we all know that several of the diversified and large cap products had about 30 to 35% in companies in the mid cap and the small cap space. So when there's a change in terms of scheme mandate, many of these funds are realigning their portfolios, and you are seeing probably about $10 to $15 million of positions in mid and small caps being moved out into other into the market or into other schemes. So this also has been a temporary pressure on the mid caps and small caps. We see this scheme rationalization also ending in this month, basically. So I think into the next fortnight we will see that there is a lot more stability that comes in also from that perspective. So combined with all these factors, I think it is a fairly decent entry point that one can look at mid and small caps, given that the growth outlook on earnings across a diversified set of companies and sectors is looking up pretty strongly.
Krishna, how have you been able to insulate the performance in your Sundaram mid-cap fund? I think year to date is down about 8.5%. If you could just superimpose what the mid-cap index is done in that period, we'll just bring up that graph for you if my producer can just fire it. The year to date graph for the mid-cap index. Your mid-cap index is down about 8.5%. From a 1 year perspective, it's up 9%. And from a 3 year perspective, it's up 15%. So, there's been a decent margin in terms of real returns to inflation as well coming in your numbers. How have you been able to insulate the fall?
Yeah. So I think if you look at the calendar year YTD, the mid-cap indices have fallen about 14 to 16%, whereas if you look at Sundaram Select Mid-Cap, we are down about 8 to 9%. So that would give a fair amount of downside protection to investors. And if you kind of track the Sundaram Mid-Cap scheme over a long period of time, you would find that the quality of companies in the portfolio help in reducing the down capture, as you call it. So we have a down capture of about 80%, which means that if the market falls 10%, we fall less than 8%, broadly, in that range. So, we are able to, do better on the downside during volatility and then capture the upside along with the market with a 110% upside capture. That's been the long-term statistic basically. So the kind of strong companies that we have in the portfolio with a diversified approach to investing, good management, good business with inherent business competitiveness and good quality balance sheets, all these give the advantage of a robust portfolio which can withstand market corrections. To be fair, when there is a lot of euphoria in the market, like we saw in the third and fourth quarter of last year, we do tend to probably underperform some of these euphoric moves basically. And again, that's because the fact that some of these high quality companies have been steady performers and not one-off moves that normally the low quality companies see. So I think it's a lot to do with the portfolio construct and the patience that we have as a team to sit through underperformance if as and when it comes, and then try to get back the alpha against the benchmarks. And over a long period of time, as you have seen, we have a very good outperformance and alpha creation over the benchmark and also the broader markets.
Yeah, that also. Give us a sense on what kind of diversification strategy you're adopting to generate returns in your diversified fund. The Sundaram Diversified Fund, I see a mix of large caps as well as mid caps, a big exposure to financials, I see a lot of those names, and a big exposure to technology as well. How is it that you're diversifying with underperformers as well as outperformers?
Yeah. So I think the diversified equity scheme is our tax saver scheme for the investors. This is a multi-cap kind of a strategy where we straddle about 55% in mid caps and 40-50% in large caps. So we run a multi-cap strategy here, and the approach basically is to again be with good quality companies, like as I mentioned in the mid-cap portfolio. So the approach is to be a lot more follow a strategy of buy and hold with conviction across companies which have more individual growth stories rather than to be playing off the benchmark. So while the BSE 200 is a benchmark here, we do have a lot of deviation from the benchmark for the simple reason that we run it like an absolute return strategy with bottom-up stock selection as a core. So here again, from a diversification perspective, you will find that we are quite playing the 2, 3, 4 themes that we have talked about. One is the urban consumer discretionary space. That's been holding up pretty well for the last 4 to 5 years. So we have quite a varied portfolio across consumer durables, auto, media, entertainment, etc. We also have a fair bit of retail credit, which is a part of the consumption theme, because we are seeing the propensity to leverage and take credit is been going up, and we are seeing that the next generation, as the demographics change, is a lot more keen to use credit to kind of move up in terms of lifestyle. So retail credit is something that we are quite positive there on the urban side. Also from the various the demographic improvements that we are seeing, we feel that financial services basically, which is all about insurance, etc., and wealth management, is again a big space that is opening up, and we have a fairly bit of good exposure on financial services in the fund. Moving on to the other parts of the economy, we also have built in a fair bit of exposure to the infrastructure and the cyclical stories like cement, EPC, construction, infra construction companies, capital goods, etc., which again are seeing a lot of rebound, in the last 1 year, given the kind of efforts the government has taken to revive the economy, particularly pushing infra growth agenda. So we are seeing a fair bit of rub-off on other core sectors of the economy, including cement and steel. In terms of other sectors like IT, healthcare through hospitals, and hospitality through hotels, we have a fair bit of exposure across most of the growing parts of the economy, except probably telecom and some of the generic pharma. So by adopting a fairly diversified portfolio approach here across themes spanning urban, consumer discretionary, infra, and cyclical recovery.
You are running a very diversified portfolio, and I think it is very visible. But if I look at a small, your mid-cap portfolio, the theme which is standing out right at the top is cement, followed by auto ancillary. What makes you so bullish on auto ancillary? Because you own Sundaram Clayton, you own Mahindra CIE, it's engineering and auto ancillary both. But auto ancillary seems to be a dominant theme. Is my observation right?
See, so we have about 15 to 17% in auto components spread across good quality companies like Clayton, Vapco, Schaeffler and Timken, which are bearing companies, and we also exposure to Mahindra CIE on the forging space. So here the approach has been to pick up again long-term growth stories which have a lot of strength in them in terms of economic drivers and technology or backing of management to kind of take the company forward. So if you look at all these companies, you will find a strong management behind the company with adequate technology and the product know-how available to these companies, and catering to a fairly diverse set of customers, basically, which would insulate the companies from any kind of slowdown in particular economy or particular sector. So all these companies you mentioned have good local presence across sectors and also have good export export drivers in place. So it's a fairly unique kind of positioning there. On the consumption side, again, we have another 15% exposure in the mid-cap fund towards consumer discretionary across companies like Blue Star, Whirlpool, and the like, and also on the branded retail like Trent, like Arvind, etc., which give you a fair bit of exposure to the growing branded apparel and retail market in the country. So, this mid-cap fund is a combination of bottom-up ideas which represent the emerging sectors and the growth opportunities in the Indian economy over the next 5 to 10 years. So that's why, you will find the churn in the fund also pretty much low, because we believe that, post the selection of these companies, we would like to be with them and allow them to kind of grow on the environment in terms of their operating and benefit from the changes in the economy and lifestyles and return wealth to investors.
Have you on the show. Thanks very much for helping our viewers understand how you're managing each one of your key portfolios and funds, whether it's a mid-cap fund, small-cap fund, or the diversified fund. It was interesting to know your thoughts. Let's talk earnings then. And Repco Home Finance, the management joins us right now to discuss their numbers. R. Varatharajan, who's MD and CEO of Repco Home, joins in. Congratulations.